Good evening, everyone. I welcome you all to this.
Yes, sir. Yes.
Good evening, everyone. I welcome you all to this webinar. We are very privileged to have Mr. George Heber Joseph, Chief Executive Officer and Chief Investment Officer of ITI Mutual Fund with us. And he is a veteran in the market, managing funds, and he has held positions in equity research, fund management, treasury management, management consulting. And before joining ITI, he has worked in various companies like ICICI Prudential, Tanfac, Cholamandalam, MetLife, DSP Merrill Lynch, both India and abroad. His last stint was at ICICI Prudential, where he spent more than a decade managing some of the large flagship fund strategies in the equity and hybrid categories with assets under management exceeding 10,000 crores. So we are very privileged to have such a seasoned and a person who has handled a lot of investor funds. So he'll be sharing a lot of experience with us. So he has had, and during that period, he was awarded the excellent performer in the respective categories, and he has had a senior. He was designated as a senior fund manager, vice president grade, and he is a qualified chartered accountant and also a cost accountant. It's our pleasure having you with us, sir. So I hand over the platform
Thank you, sir.
Give your presentation, and then that will be followed by about 15 minutes of Q&A by investors.
Thank you very much, sir, and for inviting me for this webinar. I'm extremely glad to address all of you. This is very unprecedented moment that we are having this webinar. A lot of people are having confusion, what to do in the markets. Markets have corrected initially in the month of March very aggressively, and then we have seen that some recovery happening. If you look at the situation, it is more of a medical problem, which is tantamounting to a financial crisis also. If you look at 2016 to 19 period, we had seen the demonetization in 2016. Post that, we have seen GST coming in, and also the Real Estate Act as well. For all three put together, there was a significant slowdown in the economy. And if you look at the historical performance of various companies in the Nifty also, large companies, be it banks, as well as many other infrastructure companies, were already going through severe pain since 2010. If you look at the various business cycles which we have seen over a period of time, 2000 to 2010, we have seen a significant bull market in the infrastructure space, utilities, as well as real estate. Prior to that, in the year 1990 to 2000, we have seen significant bull market in technology sectors. If you see, 2000 was the boom period for technology since 1990 to 2000 period. And then, the technology bubble burst happened in 2000. After that, the technology sector has not done well vis-a-vis the Sensex. For last 20 years, if you see, somebody would have bought Infosys in the year 1999, he would not have made money against the benchmark Sensex or Nifty even in the year 2020. And these are the kind of business cycles we have seen. And in the year 2010, the capex cycle in the country peaked out, and 2010 to 2020, we have seen the capex cycle deteriorating massively. If you see the big IPOs which happened in the year 2008, there was Reliance Power IPO. There was a peak of the utility sector, and real estate sector IPOs happened like DLF. All created huge market caps at that point in time. All of them have corrected massively, and those sectors have deteriorated meaningfully in the last 10 years. But in the last 10 years, we have seen a massive boom in the consumers facing sectors, be it retail or consumer cyclicals, as well as consumer staple sectors like FMCG sector also have seen massive boom. And the last 10 years, we have seen a massive re-rating in various stocks in the last 10 years. So what we have to remember is that last 4 years, significant slowdown was altogether on top of the slowdown which we were seeing from 2010 onwards in the infrastructure space, and also what we have seen in the utilities and oil and gas space. And that was the biggest challenge which the economy was facing. For all the brick and mortar businesses were facing challenges, and in between, government came with some of the reforms like tax cuts, and latest we have seen some of the reforms which has been announced in the last couple of weeks. So if you even in the budget also some of the reforms were there, but overall when you look at it, government was focused on structural changes in the economy rather than quick fixes, and that created massive problem in the near term, because whenever a structural change is to be initiated, it takes a lot of time and energy, and at the same time it is a long drawn process. And that is what we have seen in the case of Real Estate Act also coming in RERA when it was announced. Since then, all the builders are in trouble. Small builders are not able to meet the compliance standards, and therefore there is a massive slowdown in the real estate sector also. For 2013 onwards, real estate sector also is in deep trouble. All put together, we have seen crisis after crisis. Initially, we saw the NBFC crisis, which was in the year 2018, and later on we have seen the Yes Bank going belly up, and we have seen the COVID crisis now. In between, there is a problem of liquidity, which we saw in the case of Franklin Templeton announcements of winding off a couple of six funds. For all put together, there was a liquidity problem in the low-rated papers. Banks were not lending beyond a point, and there was a problem with regard to the NBFC crisis. Started off with NBFC crisis, and some of the banks also faced serious challenges because of these reasons. In this context only, we have come up with the COVID crisis, and COVID crisis has created there is a lot of uncertainty when the problem will get resolved. It will take time, but at the same time we know that someday the problem will get resolved. There is a vaccine. Almost 100 projects are going on in the world, and those vaccines will come through. But it will take time. It is a year. It's a year away at least to get the vaccines in all the medical shops and hospitals. So what we have to remember is that businesses economy was already in a reasonably slow down phase, and then on top of it we are facing a severe challenge because of the COVID crisis. So how to deal with this crisis is something which RBI as well as government has to seriously think. But the recent measures, 20 lakh crore package which government talked about, and which was announced in few days of announcements, and later on the RBI measures, it doesn't give me clear feeling. I had a lot of hopes, and I have been waiting for the situation to improve. And we have seen globally all the countries have taken serious measures with regard to the the monetary measures as well as the fiscal measures. Fiscal measures in the sense how government is going to create demand in the country, right? So that is the biggest bottleneck at this point in time, which has to be addressed by the only government can initiate those discussions as well as create demand. They can actually put money into the hands of the individuals who are needy, and they will go and start spending, and that is how the business cycle starts. Whereas we have seen unprecedented slowdown. We have never seen in the last 45 years of mine, I have not seen a period where 130 crore people are sitting at home and not working. So it is a very unprecedented situation. Government also has to come with extraordinary measures. But the measures which came in, when I look into the details, the fiscal measures is less than 2.5% of the GDP, which is very, very low compared to the rest of the world, where even in US, for example, $2 trillion they pumped into the money market alone. And the central government, the Fed Reserve, has increased their balance sheet size from $3 trillion to $7 trillion. So it's a massive, fiscal and monetary stimulus which government has done across globe. Starting, especially US is being the reserve currency, US dollar being the reserve currency, and US government taking those kind of measures. So in my view, globally the liquidity is high, which is where when the market corrected massively in the month of March, we were telling all our investors that don't worry right now, because massive liquidity has been pumped in by US and Europe and other countries, which can lead to a liquidity driven rally. So don't worry at this point in time, and don't pull out money at the wrong time. But after the rally and market recovering reasonably well, when I look at the measures which government has come up with, I think it is clearly short of expectations. Mainly because of the fact that there is no fiscal stimulus measures which can create demand, which has been announced by the government in the 20 lakh crore package which has been talked about. Or if you look at the major problem every business, every household has, is with regard to the money to spend. You don't have money in your hands, and how will you spend? Say, for example, a businessman has borrowed money, 1 lakh rupees from the bank, and they have been servicing the EMI over a period of time. And suddenly this COVID crisis came. 3 months you are complete lockdown. You are not able to sell anything, and your inventory is piled up, and maybe the inventory is the shelf life is low, and obviously the inventory itself will go for a toss. And how are you going to get the benefits of for how are you going to service your loans? It is impossible. The prudential norms or the RBI norms is that any loan which is not serviced in 90 days time, it get into an NPA status, and that has to be relaxed by the RBI also. For forbearance measures from the RBI also has not come through. For all put together, it is not looking like very easy recovery phase, unless otherwise in the coming months government comes up and gives some serious stimulus measures, fiscal stimulus especially, and also RBI gives the forbearance for the loans. If both these happens, I think there could be a respite. Otherwise, banking sector, where the weightage is very high in the index, I think that segment is looking very, very dicey at this point in time. Mainly because the balance sheets of the banks are reasonably okay, but at the same time NBFCs and other financial institutions, for them to get the money back from the borrowers becomes all the more difficult when the moratorium is getting extended. For moratorium is not the solution. You should have actually told that as of 31st Jan, whichever loan was not an NPA will stay as a standard even on 31st of January 2021. If that kind of measure has come in through, then banks would be willing to lend more, and borrowers will be at a much more ease, and they can start spending. Whereas today the demand itself is not there. Why would you borrow and spend, even if your government gives the credit guarantee and all those things? For net, my view is that we are at the bottom of the economic cycle very clearly. It is in a deep slowdown situation, and as we look forward, obviously there is the silver lining is that India is a very strong growth economy from the world standpoint. Also, strong demography. The average age of Indians, or the median age of Indians, is only 29 years. 65% of the population is below 35 years. So there are a lot of young people who can go and work. And secondly, if you look at the GSEC government securities rates, the yields are around 6%. But nowhere in the world, 6% yields is there, right? And inflation of 5-6%, that is also not there in a part of the world. So India is in a far more better situation than we have a fantastic demography, and in the last March month, we have seen the oil price also correcting massively, which is also beneficial for a country like India, who is a user of all commodities. So India is in a very good sweet spot, but at the same time, some government measures as well as some of the RBI measures, if it is very, very conducive, it would have created significant benefits for the economy. So that is what I am looking at. If can those measures come in the coming month? If not the case, so my belief is that it will be a slow recovery process. It will take at least a year's time to get back to where we were in 21st or 31st of January, and also look at the situation where we believe that this is the time you have to be a little bit more defensive post the announcements which government has done. I believe that we have to be a little bit more cautious on the way the portfolio stance should be. So what we are doing is we are going a little bit more defensive at this juncture, because the market has recovered, and now at this juncture we feel in a year's time, when next 2 quarters is going to be very, very tough for all the companies when they report, therefore there would be more downside possibilities after looking at the fundamentals and valuations and leverage situation of various companies. People might take a backseat, and there would be a situation that it can actually there could be a little bit more downside to the markets rather than thinking about one-way recovery. So I think the recovery will be very, very slow, as there is no external push from the government or the RBI which I can see. Now coming to the sectors which we like are the sectors like pharmaceuticals, which we have been overweight for a long time, and we believe that that is one sector which will do well going forward as well. At least 6 to 12 months time, there is more earnings visibility coming through, because many companies were going through the FDA issues. Those issues are now behind, and the companies they are having good balance sheets, and also the business momentum is picking up. The US also, there was a serious downfall in the margins and the pricing scenario, which also is recouping, and there is a lot of shortages coming through because of the COVID-19 requirements picking up. So overall, I believe that pharma will be in a good sweet spot in the coming years also, even though there is some sort of rally which has happened in the last 2-3 months. But I believe that that sector looks very interesting even now. The sector which you need to be very, very cautious from this juncture is banking and financial sector. Even today also, I believe that the situation is not changing for good very soon. So it will take time for the NPAs to roll out and NPAs to come into the P&L for various banks and NBFCs. So there you need to be having a cautious stance or underweight stance. So which is what we are doing at this juncture. We were more or less equal weight kind of situation, which we were thinking pre-COVID. From October 2019 to March 2020, we were believing that there is a serious recovery possible in looking at the ICICI Bank results and various private banks results. So I think that situation is again looking very dicey at this juncture. The sectors which can do extremely well from a little bit 1 year, 2 year, 3 year perspective is auto and auto ancillary sectors. Any discretionary low ticket and medium ticket discretionary items can be at a good demand, and that is the feedback which we are getting from China also, and also from some of the locations where India is actually opening up. Consumer facing businesses have gone through a significant run up in the last 10 years. The valuations are north of what we could imagine. Therefore, I would be very, very cautious there because of the valuations. Otherwise, the businesses are good, but it is not very, very attractive at this point in time. Banks and financials, some of the large banks is where you need to focus on, and those banks have been coming out of the corporate NPL cycle, and they were actually doing well, and later on it has got extended by another 1 year because of the COVID-19. So there again, if at all you want to look at large banks is where the position needs to be created. Agri and cement sectors are very, very attractively positioned. In my view, the rural economy is going to have a massive bump up in the next 1 year. If the monsoon also suits well, I believe that that is one segment can do extremely well. So when I look at some of the agri commodity plays are trading at a very, very cheap valuation. Some of the, because all the migrant laborers have gone back to their homes, and they the productivity there can actually increase, and therefore there is a possibility that rural can surprise even this year. Actually, the crop is significant surplus in crop has happened, and that is what I understand. And therefore, next year also, I believe there is a good chance that agri imports, be it fertilizers or seeds, and various sectors in that you can be a good reasonable long-term bet. That is one sector which can outperform significantly. For agri, we like cement because as soon as the economic recovery picks up, you will see that cement demand picking up, and government is thinking about serious infrastructure spending, and which is what very much required for government capex picking up, and therefore that is one segment which can do very well. If you look at the previous as I mentioned, if you look at the previous business cycles, as I mentioned earlier, 2010 to 2020, utilities didn't do very well at all. And the situation of NTPC or various companies. If you look at they have been going through massive derating. They were trading at 3 times book. Now it is trading at 0.5, 0.6 times book. I believe that utilities as a sector will do very well, especially in a time frame when you have a lot of concerns on various other sectors, especially infrastructure, capital goods, and late cycle recovery sectors. When you see that that is going to be a situation, there is no problem in consuming electricity or on the making the phone calls. For any utility oriented sectors, be it telecom or in the case of power utility sectors, I think that will be one of the places I would be looking at very seriously in the next 1 year. For these are for agri, cement, utilities, and pharma, and also since we are talking about a defensive situation to be maintained, I believe that IT as a sector is the best play to play the global recovery, as well as it is a seriously big weight in the index also. For that is one sector where I see there is a lot of merit. For all along, we were making, in the case when we saw the big downfall in the March month, we said that this is not the time to worry on any of these investments. Take a hard look on your portfolio where you have made some serious mistakes, and correct those mistakes, get into quality, and that is what you need to do. And we are also at this point in time, I believe that this is the whole structure which I am looking at. Secondly, one more point which I want to highlight is globally the liquidity is very, very significant and surplus, and that can actually lead to the risk assets doing reasonably well over a period of next 3-4 years. So in my view, we have to be the best recovery play is still equities. And debt is the segment which you should ideally be looking to be very, very soft. And within the debt segment, you need to be careful about the quality all the more than equity, because in debt, there is limited upside and, massive downside if at all you get it wrong. The upside is only 8-9%, and, the downside can be 50-60%. So if you buy a bond, you generally think that you are investing in a bond. But in a bond, when you buy, you are not investing in a bond. Basically, it is you are giving loan to a company. But when you are investing in a bond fund, you are giving loan to a set of companies. That's what you have to remember. So when you do that, always the first priority should be safety, whether you get the money back or not. So as a house principle at ITA Mutual Fund, we have mentioned very clearly that we will look at margin of safety as the first pillar. Secondly, the quality of the business, and low leverage and liquidity. So these are the SQL, that framework, if you have in mind, as an investor, it becomes very, very easy for you to choose where you want to put your money. If it is a highly leveraged business and you're buying a bond of that company, obviously the chance of you losing the bet is very high. So it's not worth, and especially when we are having fiduciary responsibilities and we are managing public money, what we have to remember is that we have to take care of the investor's interest as the first primary thing. And on that basis, there is no case for looking at buying a leveraged business. So we are always cautious on these aspects. We want to buy cheap, we want to buy good quality business, and we want to buy low leverage and highly liquid business. So, but when I look at from the next 3 to 4 years, where is the biggest opportunities, which is what we have written in our fact sheets consistently in the last since October 2019. We believe that in the next 3-4 years, at least say for example 4 years time frame you have from now, you can wait it out and invest and wait it out. I think the biggest opportunity is in small caps. People would say that small cap is not the segment to be in because smaller companies, they will go belly up and things like that. There are very high quality good companies in small cap space also. So what you have to do is select a good small cap fund and keep investing in that fund on a regular basis. But that regular cannot be especially in small cap, I would never recommend an SIP. So it should be a 6 months SIP or 1 year SIP. Whatever money you want to park in, you should park in within that 6 to 9 months time from now, and then wait it out for the next 4 years. I believe that next 4 or 5 years, the small caps as a segment is very cheap, can move into a very expensive zone in next 4 or 5 years, because the economic recovery, whenever it happens, these are the segments which will benefit the most. You look at in 2009 to 10 recovery phase, you look at 2003 to 4 recovery phase, all these periods, small caps and mid caps have done the best. Highest returns in small caps, followed by mid caps and then large caps. So our preference is to play the recovery in the next 3-4 years. Equity is the recovery play very clearly. You need to have patience on your side, and you need to have that temperament to be maintained, that keep investing at different juncture. Don't put all your money in one go. Put in regular intervals, but next 6 to 9 months time is the time you can actually increase your allocations very seriously, because then you wait it out for next 4 years, and you might my gut is that the valuations where it is today, and where the economic cycle is, the economic recovery alongside the PE re-rating also will happen. The returns can be fabulous. For 2013, I was fortunate enough to run a small cap fund in ICICI Prudential Mutual Fund while I was working there, and that was the bottom of the cycle, and we launched it in 2013 October, and eventually we were able to generate massive 300 plus kind of return, and return the money to investors. So I was heading the PMS at that point, and so we believe that there is a clear opportunity here also, to look at small caps as a space very, very solidly. So we have constructed the way we look at is that buy good quality small caps, cash rich balance sheets, and have prospects. Whatever the sectors which I mentioned, those are the sectors which needs to be definitely looked into. So when you say agri, it is not only that agrochemicals. There would be companies in the tractor segment. There would be companies in, because if you look at the tractor segment, actually it started doing well. So you look at the companies which are relating to that. So there's a holistic view of you need to have, and maybe years later, the potential would be mostly in some of the large banking names and some of the infrastructure and the capital goods names. If you see that some China led supply chain impact, and some business is shifting to India, and I think then the infrastructure and capital goods segment also will start doing well. Oil and gas as a space, a lot of it is talked about because the oil price have corrected. Maybe it might look very cheap, but I believe that next 1 year, oil is not going anywhere very soon. It will take time. I've tracked the sector very closely for a long time, so I can tell you that it will. There are capex. A lot of capex has been sidelined. So eventually, oil price will move up above $60, $65. but at least a year's time, there is a good chance that it will stay where it is or around these levels, which is a good scenario for India. That's why the current account deficit and fiscal deficit situation has improved substantially because of the oil price correcting, imports going down, and also people not spending for unnecessary things, and therefore the imports from China and various other things have gone down significantly, which is a very good situation. I was reading the report which suggests that this quarter, we will be having surplus in the current account, which is a very good scenario to have, and it could be one of the best situation. And eventually again the current account deficit will come in as we start importing and the lockdown is over. For overall, what we have to think is that if you have a 3 to 4 minimum years of visibility, if you have 3 to 4 years of waiting period, then you be in equities, and next 6 to 9 months is the period where you have to invest into a staggered manner. Maybe put 35% now, and then eventually increase your allocations. If you get a big sell-off, which I would expect, might happen in a period of next 2 quarters, there could be one more sell-off which can happen because bad numbers are going to come, and there is no intervention from the government, and there could be the hopes which was there can get lost. So if that is the case, you might get one more sell-off in which you can again peacefully invest. So be alert to pick up the good funds or good companies in your portfolio, and that is a way to think about the investing. In a way, what you have to remember is this is not the time to invest in debt very seriously. This is the time to invest into equities, because debt you invest when the interest rates are at a very high situation. So today interest rates are at a 6% GSEC yield, and interest rates are at a multi-year low. This is not the time to go very aggressive on long duration bond funds or credit risk funds, or so and so forth. That has to be looked at in a very, very different market scenario. Today, if at all you want to park money into debt segment, you need to invest in liquid funds, overnight funds, or PSU banking debt fund, which is less than 3-year maturity, which is mainly sovereign rated bonds will be there in the portfolio, and which is less than 3-year maturity. So those kind of products are better to equip to handle this current situation, because I visualize a situation in the next 6 to 12 months. You can see massive downgrades if at all RBI forbearance clauses doesn't come or government interventions doesn't come. I think massive downgrades can happen than upgrades. So we were having a call with CRISIL yesterday, which they were mentioning that there will be massive downgrades in the next 1 year than upgrades. So debt segment becomes a little bit very, very difficult in that scenario. Always be guarded when you're going into debt. You always first preference should be that don't chase returns. My investment mantra is simple. If at all you are investing in debt, you have to save capital first, and then look at the returns. When it comes to equity, you have to look at returns from a 3 to 5 year perspective. In the case of debt, what happens is that when you chase returns, the bad quality papers will be there in the portfolio, and you will get really stranded, and you can get really badly stuck. So I would always go by, as I mentioned, the SQL framework, which if you keep in mind, it is very good. I keep telling my teammates also, margin of safety, that is buying cheap is very important, good quality is important, and low leverage is very important. If you have these concepts clear, and if you have the framework in mind, in my view, next 4 years, it's a brilliant opportunity you get in once in 12 years. I'll just mention, the discussion with Warren Buffett happened in 2012 when he came to Delhi. People asked him, sir, how did you make so much of wealth? So he said, every time, every 5 years, 10 years, every 10 years, there is a big boom and big sell-off happens, right? Boom and bust, which he talks about. So every time when the boom happens, you need to sell into that boom. Whatever you have bought at equities, what you would have bought, you sell into that boom. And then you move that money into maybe a safer asset class like debt or gold. And then again, you will get a big sell-off moment where you have to act positively, and you buy into that sell-off and buy into the bust. If you see, 2000 was the technology bust, and in the bust, if you had bought, you would have made a lot of money in Infosys. But if you had bought in the peak, in 20 years you have lost money against Sensex, right? For that is the point. In 2008 bottom, if you had bought, you would have made a lot of money. But in 2008 January, if you had bought, you had a lot of, even 12 years later, you would have made only 5% CAGR, right? So it is lesser than the FD return. So even 2013 bottom, if you would have bought, you would have made a lot of money in small caps. And same way we are getting after 12 years, 2000, after 2008, we are seeing a massive crisis situation. And this is the time you have to capitalize and invest, think long term, and make money for yourself. I believe there is a brilliant opportunity. I request each one of you to look at small cap as a segment very, very seriously to invest. But it cannot be a full, if you have $100 to invest, it cannot be all 100 in small caps. It can be maximum 25%. There is a 25 rupees out of 100 rupees can be in small caps. 25 rupees can be in a balance advantage kind of fund, which is auto asset allocator kind of fund. And 50% can be in a multi-cap kind of fund. So this is the way I look at my investments, to make it 50% I put in ITM multi-cap fund, and 25% to ITM balance advantage fund, and 25% to ITM small cap fund. If you do this way, your blended investment will be to the tune of 50% into mid and small cap, and 50% to large cap. So automatically you are playing the good recovery play. And over a period of next 3-4 years, when again the market becomes expensive, tactically move your allocations from small caps back to balance advantage fund. So that is a simple way you can look at investing. But nevertheless, the point is you have to invest. 6 to 9 months is a period where you can staggered way you can invest, and then wait it out for the next 4 years. It's a brilliant opportunity in front of us, all of us. There is a lot of pessimism around, and I can say that you need to be defensive. I am, as a portfolio manager, I need to be a little bit more defensive in the next 6 to 9 months period. But at the same time, as I am taking care of the investors' money, so I need to be a little bit cautious the where I put money. But at the same time, as an investor, you have to be more positive on the long-term scenario. But in the debt segment, be more cautious. Gold as an asset class, I don't think it is worthwhile. It has its own run because of the China-US trade war, which was going on, and there was a massive bull run in there. And later on, you saw that the COVID crisis, then again, money moved up, the gold price moved up, and US was actually pumping in money, which last time when US pumped in money, gold price have moved up significantly, and thinking that, there is a lot of buying has already happened. But when I look at from a good recovery play perspective, next 4 years, gold doesn't suit well. I would say that, some contingency money you can keep in a liquid fund, or, very short tenor fund where anytime you can pull out, that is required at all points in time. And, you have to visualize the situation like COVID coming in, and maybe you are out of job and things like that. So 2 years contingency planning you need to have in a liquid fund kind of setup, or overnight or liquid fund kind of. You don't bother about the returns much, be there and, generate some reasonable returns. So this is the way you have to plan overall your investments. So I am quite bullish in the long term, very, very cautious in the near term, 9 months time, which is 9 to 12 months time. But if you visualize 1 year from now, obviously the situation would be much better, right? May 2021, if we are talking in the similar manner, obviously I would be much more bullish. Till the government package announcements, I was more hopeful about situations improving much faster than people think. But, I am taking a backseat now, saying that 20 lakh crore packages came, nothing material has been happening there. And RBI package or RBI announcements are also not conducive enough for the businesses to immediately recoup from the losses which they have incurred. So overall, that is the thought. Thank you so much, and I would be happy to address any questions if you have any. Thank you so much.
Thank you very much, sir. It was a wonderful presentation, a bird's eye view, I should say. So the perspective that you are bringing in is phenomenal. That is what a seasoned player can bring to, I mean, the amount of knowledge that is shared. We are very privileged to have that. We are having, probably I'll just open the floor for questions. First, I'll ask the Zoom, who are connected through Zoom. You can please raise your hand if you want to have a question to Mr. George.
Thank you, sir, for your comments. A pleasure coming on your webinar. We would like to have more interactions going forward as well.
Thank you, sir. Now the question, Mr. Sandeep, go ahead with your question.
Yeah, this is Sandeep from Calcutta.
Hi, Sandeep.
Hi. I just wanted to ask one question to the on the AMC industry. You are the CEO of AMC industry. How do you see AMC industry as a valuation, as an investment case? If we invest into the shares of AMC industry, how do you see it? And how an individual should value, as what is the margin of safety? What how do we value the as the AUM to the market cap, or the earning per share, or what should be the basis of valuation?
Yeah, so it's it's pertaining to our industry. I believe that this industry is going to grow. So we have gone on record saying that if you look at my past articles, I have clearly mentioned that the AUM of the mutual fund industry is 25 lakh crores today. It will go to 100 lakh crores in next 10 years, and it might happen much earlier also. Because financialization of the economy is happening. Unorganized to organized is happening. Right? For massive money will move from physical real estate, physical form to electronic form. And during demonetization, we saw that bulge up in the AUM in the case of mutual funds also. I would say that that is going to be the case in the next 10 years. More formalization of the economy, more money coming into the formal channel, and which will route to the mutual fund industry. For mutual fund industry as a whole, I am very, very hopeful about the prospects of ITI mutual fund also. At the same time, other mutual funds also in the country, in terms of scale up, and whatever AUM what we are seeing might be at the tip of the iceberg. If you take a 10-year view. Right? Now coming to the valuations, there are different methods to value each company. Say, for example, if a company is a steady state cash flow generating company, right? If say, for example, if a company X, it generates 100 rupees every year. And you know that every year the 100 rupees is going to come from the company, then you can do a discounted cash flow. And then you arrive at the net present value of the company. It is pretty easy. You apply the cost of equity, weighted average cost of equity, and then you apply that would be the discounted cash flow. For the cost of equity, generally we apply in India around 13%, but a Japanese guy, when he is looking at it, could be at 2%, 3%. So because the cost of equity there is very different to what happen in India. In India, businesses, there is less of capital, and raising money is always difficult, and the cost of equity is always nearer to 11 to 13%. So that is one way to look at it. If you know that the AUM is not going to grow for that company, then the way to value would be like this. Say, for example, any company, that the company has grown and has reached a peakish growth level, and from here it is not going to grow. The way to value that is you compare it as like a bond. Right? So when you say yield to maturity for a bond, is basically by you are discounting the future cash flows of the bond. The bond cash flows are certain in majority of the sovereign bond and all these cases. So you arrive at the yield to maturity very fast. So similar way you can arrive at that matter. Now in the case what you asked is very pertinent question with regard to AUM. Now percentage to AUM is a method which is followed, because this is an industry which doesn't need too much of fixed cost. Right? So if it is a steel company, you need to have a lot of plant machinery and all those things. It is a service industry, therefore you don't need to have too much of fixed cost. Therefore whatever flows in the top line, it will keep on flowing to the bottom line.
Correct.
So therefore, if you compare percentage to revenue, if you look at it in the case of a mutual fund, it is a very, very nice way to look at it, and that is a way to approach. Because if the company becomes bigger and bigger, ideally the earnings power only increases, and the generally what you say is that return on equity. In the
That
case of, if I say 100 rupees I invested in the business, and if I am getting 100 rupees back, then it's a 100% return on equity.
correct.
So 100 rupees every year if I am going to get. So it's a 100% return on equity business. Now in the case of mutual fund, it is a infinite equity, infinite return on equity, because you invest only 150 crores, 200 crores, then lifelong you are going to get maybe 1,000 crores per year also you will make.
Correct.
So it is an infinite return on equity business. Therefore, it's a far more valuable business than a banking business.
Okay.
Because banking is always a leverage entity, right? So you take 7 times leverage, and then you make return on equity of 17%, 18%. The best run bank, HDFC Bank, makes only 17, 18% return on equity.
And the risk of bad debt is also there. And the risk of debts are also,
and the risk of getting back the money also is there. So here the business is far superior to a banking business. So a banking business is trading the return on equity of a banking business is 17, 18% with a 7 times, 8 times leverage, whereas this business doesn't have infinite return on equity with a zero leverage. It's a very, very different ball game. I think the percentage to answer your question straightforward, I think percentage to AUM is a decent measure to look at. But that also can change, a country where emerging market like India, where AUM can quadruple in next 10 years. So then the way you look at the percentage to AUM has to be very different compared to a matured country where US or where the AUM growth can be very, very slow.
Right.
Thank you, sir.
Thank you.
Right.
Thanks a lot.
Oh, sir.
Yes, sir. Alagir Sami.
Thank.
Hello, are you
Thank
hearing?
you. Hello.
Hello, are you hearing?
Yeah, I can hear you.
I just want to ask you, when you said there will be there is a need of government to push us the market.
Yeah.
So those pushes are really hidden, or otherwise can we predict something, or can we guess estimate something? So that part, I can clear it, but that part I just want to know. I want to understand more certain things on that.
Yeah, for actually
low leverage, plus low leverage returns. So I feel that the ratio of online transactions and offline, it could be either way, ratio of offline to online transactions. I feel that most of the online transactions are now going on during the Corona period and COVID period. So most of the offline means like a small, medium enterprises, like small business. So those things are all cut off. That means we are just like a staggered at one point. So those you can combine all the things, and altogether you can comment on what I asked.
Yeah, for the second part, I didn't understand. First part, what I understood is, if I may understand your question correctly, you are asking that what is there any new package which government is yet to announce, and is there any way we can predict it? Is that your question?
Yeah, that is because when you say that government need a great push, means my mindset thinks that very simple. They can reduce or they can slash, they can cut off our tax rates.
Okay, understood.
But I don't think so they will do it, because everywhere we have the tax. So that is the one thing I feel that, but that's why I ask you the hidden things.
Yeah, absolutely. For what you said is right. I would one easier way is that to reduce the GST, further, and which is not possible. Which I don't think they are in a mood to do it, or increase the actually people have to postponing of TDS or postponing of tax collection at source is not the solution. That is only a cash flow measure. But actually they have to say that this is the way we are going to give money into the hands of people. So it could be in the form of some announcements for instead of taking away the money from the government servants, saying that we'll do the salary cuts for government servants for PMK, things like that. Rather, it should be much more focused either direct benefit transfer or some measures which can be announced, maybe 3 lakh crores, because the low end of the strata in India is very, very poor people. And, they are actually suffering massively. And we all know that, the migrant workers have been in a very, very bad situation. So how do they survive, and how do you bring up that pyramid to a certain level where they were in till 31st Jan? That is what the actual government lookout should be, and which is not seen. So I would say that it could be a form of some tax cuts. It could be in the form of some direct benefit transfers which they can do. 3 lakh crores direct benefit transfers, if they do, I think reasonably it can change the sentiment, and the cycle can start. Today there is nobody is going to buy, and when you don't have money, you borrowing and consuming is very, very difficult scenario. So that is what the current situation, and a lot of jobs are getting chucked out, and a lot of people are losing jobs, and salary cuts are happening, and across board there are changes happening. And how do you expect the boom of buying can continue? So that is where I believe that there should be a significant measure from the government. I don't know what measure they are planning, but as of now, whatever they announced in the 20 lakh crore package, they mentioned that nothing more yet. So in that sense, I'm not sure.
तो कंटेनर में स्टैंडर्ड पैकिंग होता है, बोरा में आता है. हाँ, बोरा में रहेगा.
So I'm not sure, what exactly is being good.
हाँ जी.
All right.
Sir, couple of questions which have come through YouTube. Mr. Ajay Shah wants to know elaborate effects of 20 lakh crore package. One more package likely. What is missing in the package?
So the biggest miss in my view is the fiscal spending. See, they have announced that 40,000 crore more they will spend on MNREGA, which is good. 3 lakh crores they have said that it's a credit guarantee for the MSME segment, which is fantastic. But at the same time, what is that for increasing the productivity or increasing the spending pattern of people? How do people go out and spend? Is there any measure which has been announced? The answer is no, and that is where the biggest miss is. So I feel that government should have thought about that, and maybe some measures. They know much better than me, so they will know that the post-lockdown situation they might come up with a very strong fiscal measures. Then I will change my argument. But today, the way RBI forbearance clauses have not come through, or the NPA norms have not been relaxed, and the government 20 lakh crore package which has been announced is not good enough. So overall together, it is not giving me a very, very strong upbeat feeling. So I wrote an article yesterday on how the 1991 reforms, I was comparing with that and seeing that, was it something similar to that? So there is a massive difference. The purpose also was different. At that time, we were facing balance of payment crisis, whereas today we are facing a COVID crisis, and COVID-led financial slowdown, economic slowdown. That's what we are seeing right now. At that time, it was a balance of payment crisis. But government actions were very, very focused to address that situation, and therefore, the economy recovered. And the next 3 years, if you see, the markets also rewarded handsomely. 28% CAGR market went up in the next 3 years. So something very, very tangible, if it would have come, it would have driven the animal spirits of various businessmen, and then the economic recovery could have been seen. For 20 lakh crore package, if I would say, it is the entire article was written on 20 lakh crore package. Probably that is I have detailed it out all the points which has come through in the package, And what it says is that mainly it is focused on agri, some mining reforms, defense segment, more increase in, foreign participation. And also with regard to the, specifically with the MSME segment, which is the heart and soul of the country. So 50% of the GDP is provided by MSME segment. Now, that segment, if it is not taken care, probably giving free loans and, giving some sort of booster dose package to these MSME sector could have changed the entire scenario. Maybe I'm not saying that all 3 lakh crores need be given to the poor people alone. Maybe 1.5 lakh crore can be given to the MSME companies or the businesses, for which can actually recoup the losses what they would have already incurred. For sure that some of the businesses, if it is not run for 3 months, those business loss is a loss. It cannot be recouped. If it is a car sale, you can recoup later. Car demand will come. Whereas many other businesses, the business cannot be recouped. That's where the government intervention is required to specific businesses. For whoever is needy, government should have given some boosted dose packages to them. Is what I was expecting in the 20 lakh crore package when they were talking about. So it is, even though it is in the size of the package which was announced is big, the meat in the entire, it is a misnomer that it is a 20 lakh crore package. To my mind, it is in effect, it's a 2.5 lakh crore package.
Thank you, sir. One more question. Can you share your perspective on finance sector, particularly NBFCs? Are they a good instrument considering the next 3 years?
For next 3 to 4 years, I think a lot of NBFCs, which have been good quality NBFCs, are also there, but they are going through a severe turmoil. One is, they are not able to raise money from the banks at a very attractive rates. And secondly, the demand for the NBFCs to lend also is not there. So both the sides, one is, they are already, whatever they have lent, they are worried that, it will come back or not. Secondly, banks are worried that, these NBFCs might increase their NPAs so that, banks are not willing to extend more loans to these NBFCs. Third, the demand in the entire underlying businesses also is very poor at this point in time. You look at commercial vehicles, it is at all 20-year low in terms of growth rates, or maybe lower than 2013 September. You look at car sales, it is 20-year low or lower than that. And if you look at any you have not seen a situation where the flights have stopped for 3 months. You have not seen a situation that the vehicles are not running for 3 months. So this is a very, very peculiar situation, and the impact on these is significant, and which is what government also should understand and react. I understand that India is in effect, it's a developing country. We can't behave like US. US has pumped in almost 50% of their GDP into monetary and fiscal stimulus. It's a $22 trillion economy. India is only a $2.7 trillion economy. It's a 1/10 of US, and 1/10 of what US has done. Also, if you do, it would have been massive, right? So that also has not come through. So I think to answer your question specifically, NBFCs will do well over a period of time, but you have to choose the right NBFCs. But I think the time to get into the NBFC space, stocks, and all those things is some time away.
Thank you, sir. The next question is, still the Nifty PE is on the higher level when compared to other indices. What is your view on this?
Sir, actually, looking at the PE alone is not a right metric. I'll just share my experience of attending a seminar run by Russell Napier, who was a strategist at CLSA, one of the largest MNC brokerage firms. So he runs a course on practical history of financial markets, where he teaches 100-year history of US and things like that. So when we attended, as a team, we attended a lot of CIOs and CEOs and all attended that seminar. And what he taught was that whenever you look at the broad index, you look at on price to book basis as the main valuation metric, rather than looking at a price to earnings, because earnings is a 1 year number, right? For say, for example, a company company X, their last year the earnings was 100, and the price was 1000. So you will say that it is at a 10 P, right? Now this year the price has come to 800 rupees and the earnings have dropped to 20 rupees, right? So what will happen is that it will look like a 40 P. So this is the problem with when even though the price has corrected. So when I give you only the price number, say 1000 and 800, which one is cheap? You will say that 800 is cheap. When I give you the PE number, one was at 10 P and one is at 40 P, you will say that 40 P is costly. So this is the problem of looking at PE. Always remember that price to book is a better metric because it is relating to the net worth of the company. And net worth of the company in India, in Indian accounting standards, generally the net worth is also a very conservatively defined number, because all the books of accounts are maintained on historical cost or realizable value basis. So if the assets are on historical cost, the book value number also is substantially lower than the real value. So price to book can be a good metric to look at, especially in the case of most of the companies in Nifty. Banks and NBFCs, you can look on price to book basis. Commodities, you can value on price to book basis. So, every company on its own history, you can value on price to book basis. What the whole thing which I learned from that seminar. So which is what the entire crux of our balance advantage fund, asset allocation framework also. The valuation is based on the price to book model. So on price to book basis, currently Nifty is not very expensive. Price to earnings, obviously the earnings of companies itself is not working. Where is the earnings? So the earnings itself is not there, then obviously the price to earnings will look very high. But this is a temporary phenomena. It will change. Earnings will come back. For price to book basis, it's at 2.2 times. And on 23rd March, it went down to 1.89 times, and which was equivalent or lower than even 2008 October Lehman crisis period. So that is why we said that in 2020 March, when the market bottomed out at 1.8 times price to book, we said this is not the time to worry. Whereas today it is at 2.2, 2.3 times, which is also not expensive scenario at all. Anything about 2.6 times, you can say it is getting into the expensive zone. It is not an expensive zone even now.
Thank you, sir. A couple of quick questions.
Sure, sir.
Sorry to have you on hold for a long time. How job loss in near future will affect market? And if connected, you can also say how long the market volatility will be.
How long? How long?
Market volatility. You expect the market to be volatile?
Yeah, for sir, market volatility is a very simple answer, because it will be there as long as markets are there. So it is not going to go away. Only thing is the volatility can increase when market is reaching the bottom. Most of the time, market peaks are generally less volatile and market bottoms are more volatile. Because when the market bottoms comes, that's when people ask questions. This company will not survive, and this company is, when the valuations are dirt cheap, people have all the more questions. As a fund manager also, I listen to more questions when the market's at the bottom. And when markets at the peak, people don't ask us. People think that when they invest, they make money, a lot of money. So market bottoms are always very volatile, and that volatility will continue. And because the change of hands happen, strong guys will come and buy, and people who can think about long term will come and buy, and people who can't wait, and day traders and many people will lose out and they sell off. So that's why the volatility, the emotion swings are what the volatility is, which will continue. But at the same time, now when so what was the other question you were asking?
It was related to how the job loss.
For job loss situation, sir, is pretty murky situation even before the COVID crisis. So if you just search on Google and put job loss situation in India, you will see that prior to COVID, it was 23.5% was what reported by CMI, Center for Monitoring in Indian Economy. For 23.5% people in India are having job loss situation. which is very, very high number compared to Indian in our own history. Now, post-COVID, the numbers would have definitely increased substantially, and especially in the unorganized sector and some of the financial services sectors, whatever I am hearing in the banking sector, there's a lot of job losses happening at this point in time, and therefore the numbers would have only increased. So, but what you have to remember is that whenever the job loss situation is at the peak, unless otherwise it goes into an social unrest mode, you will see that for the economy it is a contraindicator. When the job loss situation is the highest, it means that economy is at the bottom. Right, in 2011 US job loss situation was at around 11.5-12%, and that was the highest job loss situation in the recent times. And from 2011 to 2020 it was a dream run of growth which US showcased, and it reached the 3% job loss situation scenario, which was a 169-year lowest point they reached, and then the COVID-19 crisis came. For whenever the job loss situation is the high, remember that the economic is at the extreme bottom. From there, the recovery can be much faster.
Thank you, sir. One last question. There are some rumors that some of the AMCs are transferring bad assets or risky bonds to pension funds or hybrid funds. That's a matter of concern. Then the people say that it is better to keep away from debt funds, credit risk fund, etc. What is your view? Should they continue investing, or should they stop their SIPs if they have?
Yeah, sir. I think credit risk funds at this point in time, or long duration bond funds, as I mentioned in my talk, I clearly mentioned that these are the segments which people should avoid at this point in time, because next 9 to 12 months, there will be more downgrades than upgrades, and you never know which paper is going to get impacted, which debt paper is going to get impacted, and that is always risky. For be it in if at all you want to park money in the debt fund, the best way to park is on low duration bond funds. And that is what we have been writing from May 2019 onwards. If you see ITA mutual fund, all fact sheets, we kept on writing that, be it in low duration bond funds, high quality credit funds, it means, you need to be in extreme short end of the curve. When the yield curve, a short end of the yield curve is where you have to place your bets, and that is what the view currently also we have, because economy was slowing from 2016 onwards. So there is no case for going into credit risk and going into because there is a possibility of an accidents happening in the debt market, and that is what indirectly is happening. We have seen DHFL issue, we have seen ILFS issue, and there will be many number of issues like that which will perk up. And that is what you have to be careful about. So I would say extreme high quality low duration bond funds is where your money should be parked, be it overnight, liquid, or banking and PSU fund. And I think money parking, AMCs purposefully parking and all those things, I have my own doubts, because it's a highly regulated industry. And the funds which have been they have pulled out from the market also by Franklin Templeton. I think all of them had a genuine right approach or process in place, but the issue is that the debt markets in India is very, very shallow and very, very illiquid also, and it is very opaque. There is no online transactions like what we do in stock markets. There is a wholesale debt segment in the NSE, but the trades happening over there is very low. So ideally, if it is a much more deeper market, generic benchmark, which like what we have in US and all is there in India, and more trades happen on online platform, and there is no counterparty trades and intermediaries involved, it will be all the more better. And I would hope that RBI will take more initiatives to have only online transactions. Then that will be beneficial for the debt markets. But I would genuinely believe that there is a lot of processes all the AMCs follow, and it is unlikely that purposefully the bad assets is transferred here and there, and which SEBI is also a fantastic regulator, I would say, and I have very high regard for them, and I believe they actually look at it very, very seriously and question all these kind of trades and take people for task. For I don't believe that assumption. But nevertheless, there will be pluses and minuses everywhere. And what has happened in different organizations, I can't comment. But we have as a IDEA mutual fund, we have made a very simple philosophy that whatever is right for the investor, we will do. Otherwise, we will not function. Right. So in that sense, from my side, I can really assure you that whatever we are doing will be at the best interest of the investor as well as the independent financial advisor also. So we will not try to create any issues on that regard.
Thank you, sir. So before leaving, what is your ideal asset mix for a typical conservative investor and an aggressive investor with a 3 to 4 years time frame in mind?
Sir, I would say that 2 years expenses for living has to be there in the liquid fund or overnight fund or FD, either of these three, because at any time you should be in a position to take out money. For 2 years, savings has to be kept there. Balance money, this is the time to, if you have 4 years, as you mentioned, 4 years window is there for investing. This is the time to invest into equities and less into debt. So if you have 2 year savings in liquid fund or overnight or in FD, fixed deposits, and then you are allocating money, you want to allocate money between debt and equity, I would have maybe 25% money into extreme, maybe banking fund or overnight funds, as a SIP for the next 6 to 9 months. Otherwise, 1/3 of my money will be invested today itself, because I don't want to, because it's a very cheap market scenario, even reasonably cheap market scenario for 1/3 of your whatever your investable money. Say for example, total wealth you have is 100, 10 you parked it in liquid funds for your 2 year expenses. Then you have 90, and that 90 when you are parking, I would park at least 50 rupees in multi-cap funds, and 25 rupees in balanced advantage kind of category funds, and 25 rupees in small cap. That 25 small cap, I would maybe right now I'll put 20, and balance I'll put right now I'll put 15, and balance I will stagger it and put in the next 6 to 9 months time. So overall, I would say the good part of the allocation should be towards equity at this point in time. There is no merit in putting money into debt, and within equity, balance advantage is a fantastic category, because that's where you can it is an auto allocator between debt, equity, and arbitrage. For today, most of the balance advantage funds would have reasonable equity level, and but at the same time, over a period of when the market becomes expensive, automatically it will move into pure debt and arbitrage fund. So in that sense, 25% always you should park there, which will give you FD plus return, and 50% towards multi-cap for a long-term equity allocation. Another 25 towards a small cap. This is the way you should allocate your 100% of your wealth, 100% of your equity money. Maybe 25% is where you should park in into short end of the debt segment. So overall wealth 100, 25 you park it in the short end, and balance 75 you put in 50, 25, 25 ratio into multi-cap, BAF, and small cap.
Thank you, sir. That was a wonderful insight. I hope this will be, come in good stead for people who are watching and people who are going to watch it in the YouTube in the days to come.
Thank you so much.
It was pleasure hearing you, the amount of insight into various sectors and the investment per se, into various asset classes, and your wisdom about various sectors, be it pharma, auto, cement, agri, utilities. I think this will help the investors to create wealth in the long term. It was a pleasure talking to you. It was
Thank
a
you so much.
privilege,
It was a pleasure talking to you as well, sir.
it was a privilege for us to have you on our event. Thank you very much, sir.
Thank you. Thank you so much.
Thank you.